Anthony Grasso here, bringing you financial news you can use. In this video, I'm going to go over the Federal Reserve's tapering off program, which is slowly decreasing the buying back of Treasury bonds and mortgage-backed securities. Should we worry about an impending market crash coming up soon? Well, let's find out together. So I'm going to go over the current tapering program announced by the Federal Reserve. I'm going to give a historical perspective on previous tapering programs done by the Federal Reserve, the Federal Reserve's potential future interest rate hikes in 2022, and give my professional opinion on if we're on the verge of a market collapse and crash. And as always, folks, don't forget to smash that like button down below. Definitely helps. And consider subscribing and hit that notification bell if you like your daily stock reviews and recommendations from an unbiased source. So let's get right into it. This video is brought to you by Webull, which is an online brokerage trading platform where you can buy stocks, options, ETFs, and cryptocurrencies. If you sign up today and deposit any amount, you can get 2 free stocks by using my referral link in the description below. All right, so let's get right into it. So last week, the Federal Reserve said it would begin tapering the pace of its asset purchases later in November. On a monthly basis, what this means is a reduction of $10 billion less in treasuries and $5 billion less in mortgage-backed securities. Now, the Federal Reserve has 2 high-profile ways to stimulate the economy during a severe recession or what was brought on by the COVID pandemic. Now, they are cutting interest rates and purchasing government-backed debt, in this case, which is Treasury bonds and mortgage-backed securities. Now, these moves are intended to keep the economy with a lot of credit and keep borrowing costs pretty cheap. Now, then what the Federal Reserve does when they feel that the financial system is ready, they will eventually raise the interest rates up and gradually decrease how many government-backed debt, aka Treasury bonds and mortgage-backed securities, it is buying each month in a policy known as taper, whereas we come up with the term tapering. So the Fed also said that the tapering in no way implies it will begin raising short-term interest rates once the bond buying is over. Now, in other words, even though the Fed has begun to take its foot off the gas, so to speak, it is not ready to start tapping on the brakes. Now, you might be asking yourself, well, what does tapering really mean to me as a consumer? Most consumers will understand the direct impact if the Federal Reserve starts hiking interest rates and how that directly impacts their finances. Now, think about getting a car loan, a mortgage, a boat loan. Increased rates equals less money in your pockets and more that you will think twice about making that big purchase because of a decreased buying power. Now, on the other hand, tapering implications can often be much more complex, but I will try to explain how that works and how it might impact you. So tapering refers to a post-crisis asset purchase plan. Now, the Federal Reserve announces a predetermined pace that is started slowly and gradually decreasing how many assets it is buying each month. Now, bond buying stimulus, which is the process of purchasing securities for stimulative purposes, is also known as quantitative easing. Now, quantitative easing helps the economy by reducing long-term interest rates, that which makes businesses and mortgage borrowing really cheap, and by signaling the Fed's intention to keep using monetary policy to support the economy. Now, the Fed turns to quantitative easing when short-term interest rates fall nearly to zero and the economy still needs some help. Now, the Federal Reserve purchases those assets on the open market, which then reduces the supply of those bonds in the broader market. Private investors who desire to hold those securities will then bid up the prices of the remaining supply, and which lowers their yield. Now, this is often called the portfolio balance effect, which is a mechanism and particularly important when the Fed purchases longer-term securities during periods of crisis. Now, even when short-term rates have fallen to zero, long-term rates often remain above this effective lower bound, providing a more space for purchases to stimulate the economy. Lower Treasury yields are a benchmark for other private sector interest rates, such as corporate bonds and mortgages. Now, with low rates, households are more likely to take out a mortgage, a car loan. Businesses are more likely to invest in equipment and hiring workers. Now, lower interest rates are also associated with higher asset prices, such as the drastic rise in home values, now increasing the wealth of households and thus driving spending. Now, the assets that are added on the Federal Reserve's balance sheet recently has ballooned to more than $8 trillion since the pandemic. This is not the first time the Federal Reserve has done this. After the 2008 financial crisis, the Federal Reserve back in 2013 began reducing the mortgage-backed securities and Treasury security purchases by a cumulative $10 billion each month. Now, this process concluded 10 months later when those purchases hit zero. I will go into some historical data in just a bit, but don't confuse tapering with the Federal Reserve selling assets and shrinking its balance sheet. This is just a way for the Federal Reserve to simply gradually reduce over a certain period of time on how much it is buying. Now, they won't stop buying assets altogether, but just buy them at a lower rate than it had in the past. At some point after tapering is complete, the central bank is likely to gradually reduce the size of its balance sheet by letting maturing securities just run off the balance sheet without replacing them, as it did from October 2017 to 2019. Now, the Federal Reserve's motivation for tapering is to slowly remove the monetary stimulus it has been providing the economy. Now, the Federal Reserve way back in December gave guidance on when they said tapering would begin, is when the economy has made substantial further progress towards its goals of maximum employment and price stability. So now let's look at historically what has happened to the markets when the Federal Reserve started a tapering program. We must look at 2013 to 2014. Now, the S&P 500's response to the start of the Fed's tapering program back then, it followed a sub-crash of 6%. Which we call a tantrum. Now that should offer some encouragement to today's investors. We call it the taper tantrum, is where financial markets experience a small downturn in response to tapering. Now, taper tantrums may lead central banks to promptly reaccelerate asset purchases and essentially reverse the process of tapering. Now, central banks, for the most part, have not been able to sustainably unwind their expanded balance sheets. Now, according to a CFRA report, in the prior 10 months before the tapering period back then, the S&P 500 posted a double-digit gain in price, possibly due to the reasoning that if the economy is strong enough to withstand the removal of supportive bond buying activity, it is healthy enough to continue to expand on its own. Now, the S&P 500's advance was also accompanied by gains of all sizes, styles, and all sectors in the S&P Composite 1500 index. In addition, nearly 80% of the 123 sub-industries increased in price, led by airlines, aluminum, biotechnology, and healthcare facilities. Now, the losers, though, were led by sub-industries predominantly in the consumer discretionary, energy, and material sectors. Now, comparing today's tapering to that of the 2013 and 2014 will prove challenging, though, at best, since fundamentals are very, very different from that 8 years ago. Back in mid-December 2013, when the Fed started its tapering program, the year-over-year rise in headline consumer price index was only 1.5%, inching up to 1.6% 10 months later. Now, today, inflation is substantially hotter at 5.4%. Conversely, the 10-year Treasury yield has nearly twice as high as that in 2013 as it is today, and actually declined by nearly 75 basis points by the end of the tapering. West Texas intermediate oil prices were higher in 2013, but slipped to a level similar to today by October 2014. And gold prices, on the other hand, were between $600 and $645, which is higher today than it is in 2013 to 2014. Now, during the prior tapering period, the real GDP rose from a 12-month growth rate of 2.9% to 4.7% by quarter 3 of 2014, compared with a 5.5% growth projected for calendar year 2021. Also, quarter 3 of 2014, the S&P 500 earnings per share rose 9.2% year over year versus 7.6% at the start of the tapering. Now, the CFRA report expects the current 36.6 earnings per share growth rate to be trending lower by mid-2022. So, valuations are of concern to me, and they should be a concern to investors today, since the 22.2 multiple on a forward 12-month earning per share today is substantially above the mid-15 multiple during the prior tapering. Finally, the Fed started raising short-term interest rates back in December 2015, or nearly 14 months after the end of the tapering period. This time around, we think the Fed could start hiking 6 months later, as we see the first quarter point rate hike coming in about quarter 4 of 2022 and proceeding into 2023 at a measured pace. It is also important to note that some members of the Fed's policy committee, known as the Federal Open Market Committee, noted back in December that employment remains below the pre-pandemic level, suggesting that patience is needed. Other members have expressed concern about inflationary pressures and excessive risk-taking in financial markets as a result of the Fed's asset purchases. Now let's forward the clock a little bit and look at today for a minute. You know, the unemployment rate right now is hovering around 4.6% in October, which is still above the 3.5% level prior to the pandemic, but well below the pandemic high of 14.8%, which is really high. Inflation, on the other hand, is out of control. Economists expect a government report due out this week to show consumer price inflation rose 5.8% in the 12 months through October, in what would be the fifth straight month of above 5% year over year price increases. Now, the Federal Reserve has a standing 2% inflation objective per year. Now, the Federal Reserve has said that if there is a repeat in 2022 of the inflation performance that has happened in 2021, they would not consider that a policy success at all. To me, that's a hint of a mid-2022 interest rate hikes. Now, the current outlook is that economic growth should drive the unemployment rate down to 3.8% by the end of 2022, which would eliminate the 4.2 million employment gap relative to the months before the pandemic. Now, the Federal Reserve officials have been on record back in September that they wanted to first get the unemployment numbers in check before going down the path of increasing interest rates. But the 18 Federal Reserve officials are evenly split over the need to raise interest rates over the next year, with the majority of them showing rates raising more steadily in 2023 and 2024. St. Louis Federal Reserve Bank President James Bullard repeated his outlook that the Fed will need to raise rates twice in 2022. With the U.S. jobs market already so tight, it is adding to inflation through growing wage and compensation costs. And he said, quote, "If inflation is more persistent than we are saying right now, then I think we may have to take a sooner action in order to keep inflation under control," adding that he feels that many of the millions of Americans who left the workplace during the pandemic are not likely to return to the job market, leaving the labor supply pretty tight. Now, how does this tampering affect the stock market? The qualitative easing policies implemented in the aftermath of the financial crisis of 2007 and 2008 had a favorable impact on the prices of stocks and bonds in the U.S. financial markets. Now, as a result, investors were concerned about the impact of a potential reduction or tapering off, so to speak, of these favorable policies. Now, since tapering is a theoretical possibility, it has never actually been successfully carried out by central banks that instituted an economic stimulus driven by qualitative easing. Now, it is hard to say exactly what tapering off would have on the stock market itself. However, in the past, it is widely believed that once the Fed again began the slow reversal of its economic stimulus, the stock market would react negatively. So do I think there's going to be a stock market crash coming based upon the current tapering and possible future rate hikes? Well, I don't think there's going to be a crash per se in the next coming up months to the end of the year, but I do see some challenges and possible correction in the stock market in 2022, and here's why. Now, one challenge is to the current onward and upward mindset and valuations. The current price to earnings on the next 12 months earning per share estimates is 22.2 times, or nearly 32% above its average since 1999. Prior to the current bull market, investors had to look to the tech bubble that ended in 2000 to find similarly stretched valuation levels. However, due to the lack of attractive investment alternatives, possibly cryptocurrencies, right? The price to earnings multiples will likely remain elevated until the Fed starts its newest rate tightening program into 2022. My thinking is that money will then start to flow from the stock market to possibly cryptocurrencies, a few of them, in 2022. Only time will tell, though, on that prediction. Now, the markets have reacted positively with the Federal Reserve's current tapering, so far with stocks turning positive and government bond yields inching a little higher. I mean, the markets basically have shrugged off the news, and I don't think it can derail this raging bull market that we see ourselves in at this exact moment in time. Now, since 2008, the S&P has performed better when the Fed has expanded its balance sheet, but what if investors are confusing that correlation with causality, right? One has to look at Japan's stock market when they did more monetary intervention than any country in the developed world. Now, since 2000, the Bank of Japan has expanded its balance sheet more aggressively than the Federal Reserve. Now, according to the Forbes article, Japan started a quantitative easing program that included bond purchases in March 2001. Now, within 2 years, the Bank of Japan increased its monetary base by approximately 60% or so. Now, since then, the Bank of Japan has expanded its balance sheet at a faster pace than the U.S. Central Bank. However, this does not appear to have done much to enhance the relative return profile on Japanese equities. A good way to test any macro investing thesis is to think globally and to look at Japan. If qualitative easement was the main bullish catalyst driving the US stock market, it should have been even more bullish for Japan's market. Now, according to this Forbes article, in the words of Gertrude Steen, there is no there. Now, hence, there is no reason to believe that qualitative easing tapering is necessarily bearish for stocks. Another fear of investors is that qualitative easing will cause interest rates to spike in a harmful way. But contrary to popular perception, yields have risen during the past qualitative easing episodes and have fallen when the Fed started to taper. Now, I do believe that there are legitimate reasons for investors to be cautious right now, but at this moment in time, I do not feel that qualitative easing tapering is one of them. I have my eye on the stock market's overall valuation in general, which is near its highest levels it's ever been in the 20 years. Now, let's bring up the Robert Shiller's S&P cyclical adjusted price to earnings. Now, of course, we all know that what happened after the stock market valuation reached such a lofty level back in 1999, stocks plunged. It took 7 years for the S&P to fully bounce back, and then it nosedived again with the financial crisis of 2008 and 2009. I keep discussing in my stock videos that valuations, and a lot of them are extremely expensive right now and are trading at a premium that hasn't been seen in more than 2 decades. Now, historically, there's been compelling inverse correlation between the cyclically adjusted price to earnings value of the S&P 500 and the returns over subsequent years. Now, the market will remain vulnerable to significant decline should investor risk sentiment deteriorate, if progress on the virus containment disappoint, or the economic recovery stalls out. And the statement came directly from the Federal Reserve yesterday. One will hope that this inflationary period is transitory and not structural, but as the time goes by, and the days and the months that go by, it seems more permanent than transitory. Another area prompting the Fed worries is China's real estate turmoil and its regulators focus on the highly leveraged firms, including China's Evergrande Group. Now, the Fed noted in the report, financial stresses in China could strain global financial markets through deterioration of risk, sentiment, pose risk to global economic growth, and affect the United States. Now, as of right now, I do not see any immediate threat, but going into 2022 mid-year per se, yes, I do see market weaknesses next year if inflation stays out of control right now and the Fed brings out the interest rate hikes to keep it in check, which I feel they should have done right now, but I'm more of the guy that says, bring down the house now, but that would mean a crash and burn situation, which we would all like to avoid right now, so we can get out of this gradually and not lose our house. So let's continue to keep an eye out and see the warning signs of immediate doom and gloom. But until then, let's just make some money in the market right now. Now, if we do see inflation remain stubbornly high though, or even go higher in Q1 of 2022, then that will definitely spook the market and you will see probably a nice correction going into Q1, Q2 of 2022. I would like to leave you with this quote, folks, from a saying on Wall Street: the trend is your friend until it ends. Let's all repeat that real quick. The trend is your friend until it ends. So there you have it, folks. And as always, don't forget to smash that like button down below and consider subscribing and hit that notification bell to like your daily stock reviews and recommendations of longest cryptocurrencies and market news. Until the next stock update video today or market update, ciao, folks.